The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Good morning. You're listening to Money in the Morning with Mitch Goldberg on LI News Radio 103.9 FM. We begin the day with the stock market futures desperately trying to find solid footing after yesterday's hand grenade tossing contest with Jerome Powell, chairman of the Federal Reserve, in front of the Senate Banking Committee, telling us rates are going higher. I will slay the inflation dragon, even if I have to bring everybody with me. It changes the calculus from soft landing, no landing, definitely makes the hard landing scenario more prominent. I'll explain all this, but the bottom line is stocks yesterday go in the tank. I was just talking how it's been such a tame market this year. We haven't had any dramatic down days this year. We've had a lot of minor fluctuations this year, but I'm talking on a day-to-day trading basis of the major stock market averages, Dow, S&P 500, NASDAQ composite. But it's been not a lot of extremes, just day-to-day volatility. Yesterday, we talked about this pretty extensively, that twice a year, the chairman of the Federal Reserve appears before Congress. It used to be called the Humphrey Hawkins testimony. I don't know why they changed it, but he does this testimony in front of Congress, and he says, this is what's going on. This is the way we see it. This is where the economy is. Here's where we are in the cycle. Here's our view of inflation, what's causing it, why we expect it to last or not last, what we see for interest rates, what we see for labor. Remember, the Federal Reserve Bank, that's the central bank of the United States, has a dual mandate. It's price stability. People think it's inflation. It's price stability. It's not no inflation. It's just price stability. The Fed interprets price stability as a roughly targeted 2% annual inflation rate. Their other mandate, because I said dual mandate, remember, is maximize employment, given the economic conditions. So as far as the Fed goes, we had a very gentle, kinder Federal Reserve with Jerome Powell, really pushing on maximizing employment for minorities, for everyone, and he really leaned on low interest rates, quantitative easing, all the things that the Federal Reserve could do to keep interest rates low, keep the money flow going, make it easier to be approved for credit. Well, employment is in really good shape right now, so now he's got to slay the inflation dragon, the other part of the dual mandate. And to do that, you've got to raise rates. You've got to make it harder to get approved for loans. And when you do get approved for loans, you're paying a much higher interest rate, which means payments for cars, mortgages, business loans, credit card minimum payments. All of those things have been going up, up, up. So, means people are going to borrow less money because the affordability issue. If it's going to cost more money to borrow money, I have to either borrow less or just forego purchases of big ticket items. That slows down the economy. You used to be able to buy an appliance at Best Buy in 3 years, interest free. You don't see those deals. Okay. So in any event, let's take a look at what happened in the market yesterday. Just Powell, it's like he's shooting, Sam's at us people on the ground here, trying to hold the fort with the market and trying to figure out what's happening with the economy. It was like the Arnold Schwarzenegger moment, back to the chopper, with Powell speaking yesterday. And as his testimony went on in front of the Senate, the worse it got. So the Dow yesterday was down 575 points, down 1.72%. NASDAQ down 145 points, down 1.25%. And S&P 500 was down 1.53%. The script is flipped a little bit. Usually the NASDAQ does the worst of the three major averages in a down day. And the Dow holds up holds up the best, or I should say down the least. But in this case, the Dow is the worst one. The S&P was in the middle. That's usually the case. And the NASDAQ was the best performer, meaning down less than the other less than the other two major averages. Gold going down steadily. Seems it goes down constantly. And, the worst thing for assets like crypto, if you want to call that an asset, I really don't. But the worst thing for crypto and gold is a Federal Reserve that gets true religion about fighting inflation. So oil was down $1, also down $1.21. And just so you know that when the Fed raises rates or even indicates that they want to raise rates, it makes the dollar stronger. Any country, when the central bank raises rates, it makes that country's currency worth more because you're earning a higher return in that currency. So commodities that are priced in dollars get weaker when the Fed raises rates. So stronger dollar means the price of commodities goes down. That's just the way it is. So the commodity complex took a little bit of a hit yesterday too. And the confusing thing here is the VIX. That's the volatility index, the fear gauge. The VIX in a day like yesterday, you would think it would be up like 10, 15, 20%, the VIX. Because when the market has a big down day, the VIX goes up. It's a fear gauge. People worry. That measures fear. That measures the cost of hedging by large market participants. Okay. The VIX was up barely. It's at 19.85, still under 20. It was up 20.25, was up 1.28%. Very small move given the size of the averages. So somebody is not worried. Let's put it that way. I don't want to make it like there's some one person out there who's not worried. I'm just saying collectively on the ag, yesterday's market was not panic driven. It wasn't the wholesale just lights out for the world. It was pretty orderly. The losses accelerated a little bit into the end of the day. And again, we're looking at futures. Futures, I wouldn't call this a bounce. They're barely up, maybe just finding their footing. But, I always say the futures is just a moment in time. They don't actually they don't actually tell you what the market's going to do for that day. And I said that yesterday. I said actually futures are up right now. And yet we had pretty much the worst down day of the year yesterday. So that's why we say don't judge the day by the morning futures action. It's just a moment in time. Okay. So that's the big news. And we get to do it all over again because it's a 2-day testimony. Jerome Powell, chairman of the Federal Reserve, is speaking now in front of the House Financial Services Committee. They get to do it again. House members took a look at transcripts and watched testimony from Powell yesterday. They don't want to ask him the same exact questions. They want to come up with unique questions. So it's harder to go second because now you've got to really put your thinking hat on and ask different questions. Some of them are going to be strange and some of them are going to be more like they're trying to guide Powell into a box because they're looking for an answer. The House is typically, it's going to be a little bit more cantankerous, a little bit more theater. I want you to put that aside and focus on the message. Okay. People have gotten really good at getting their social media moments, but we just have to focus on the message of the Fed. And that's not going to change based on his audience from the Senate to the House. Inflation is coming in stronger. Labor market has not only held up, but it seems to be getting stronger. And so he's got to go through this whole thing again. And I don't think he's going to add any new color to his remarks yesterday, Powell, but we'll see if he adds anything else to it. I don't think he does. So I could see the market being a little bit more tame today. So that's the big news. I hope you don't mind me nerding out on this topic. But it's a big topic. That's the topic of the market. We're going to talk next about what this means for you, what we're going to do with all this stuff. Private payrolls just came out, and how to actually build a bond portfolio. So stick around. We're going to do a few more things. We're going to talk about some stocks. I love that. You're listening to Money in the Morning with Mitch Goldberg, LI News Radio 103.9 FM. We'll be right back. Thank you. Thank you. You're listening to Money in the Morning with Mitch Goldberg. To learn more about me, or if you'd like to take a conversation between you and I offline, one-on-one, check out moneyinthemorning.info. All of my contact information is there, a brief bio, a link to my firm's website, Client First Strategy. And, we could take it from there. I love hearing from you, and it's always nice to speak with listeners and bond with you. And then I get to ask you questions like, hey, what do you think of the show? What do you want to hear? What should I be teaching? What should I be talking about? All good stuff. And your feedback to me is incredibly valuable. And I want you to know I just greatly appreciate you taking the time to tune in. It means a lot. So we begin the day with the futures in the Dow, S&P, NASDAQ flat. Just, you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. Nobody wants to really make any sharp moves in the morning. We pretty much know that what Jerome Powell said yesterday to the Senate, it's going to be the same thing in his remarks to the House. There might be a couple of zingers as far as questions that are thrown at him, but he's not changing his tune. Inflation is too damn high. The Fed's going to raise rates, and it just signals how aggressive. That's the key. This all signals how aggressive the Fed will be to tame inflation. Elizabeth Warren, senator from Massachusetts, was grilling him. I don't know if you'd say grilling, but challenging him and saying, you raise rates and throw the economy into recession. Millions of people, like 2 million people, could lose their jobs. And Powell's remark was exactly this. Well, would that be better than having 5 or 6% steady inflation on the entire country? It really is a conundrum, because getting into this issue of higher inflation, we got a lot of benefit. We got, higher stock markets, lower interest rates, a lot of jobs created. But the downside, the, side effect is inflation. So we have to fix that. And inflation is pretty pervasive. I do financial planning for clients. And when you factor in just a low rate of inflation, like 3% of expenses, you throw in 6%, healthcare expenses, you'd be amazed how expensive things get about 8-9 years after you retire. You're like, oh my God, I can't believe how much everything costs, because you don't really think in terms of inflation down the road. Yeah, I know prices will go up. Generally speaking, in my mind, I'm aware of it. But when you plot out the numbers using a real rate, you're blown away. Your jaw drops. And this is something I see people's jaw drop like every day with this. And then we've got to take steps now to mitigate this. And of course, the sooner you take steps to mitigate that, the better off you are. It's not just about throwing more money into the market and increasing your investments. It's about being tax aware now. Should you do Roth 401k versus a traditional, regular 401k? Should you do an IRA conversion into a Roth? Basically things to do to become more tax efficient after you retire. Should you claim Social Security at 62? I challenge everybody when they say they want to claim Social Security at 62, why they should wait. And so let's get into this, a little riff on Social Security, okay? So this is the deal. A little sip of coffee. This is the deal. A lot of people think of Social Security as an investment. I put money into it. I'm supposed to get a certain amount out. I want to claim early because if I don't live long enough to get all that money, I want to make sure I get it. You know, I don't know what my lifespan is going to be. We just don't know these things. And then some people look at it. This is how I look at it. For me personally, I look at it the way you look at it, but I will challenge you, not in a disrespectful way, but to make sure you're thinking about it from all the right angles. I look at it as this is a supplement to income in my later years. If I get every penny out of Social Security that I'm supposed to get, great. If not, if I wait till I'm 70 to claim Social Security, I'm getting a lot more money every month in terms of my income. From the age of 67 to 70, full retirement age to 70, you're getting an automatic 8% increase. I mean, where do you get 8% guaranteed? Okay, that's what you get when you wait from the age of 67 to 70. It's really incredible. Plus, you're also earning the COLA, the cost of living adjustment. So 8% plus like the 8 and change percent COLA that people got, it's like a 16% increase. It's huge. So I look at Social Security as more of a supplement in my old age. I'm 55. I'm not too far away from that. So this is an important topic to me. Okay. For a lot of you, this is a topic that you're thinking about. Some of you, it's still far in the future. A lot of people say, well, it might, Social Security might not be here. It'll be broke by the time I'm ready to collect it. No, let's not get too crazy with that. There's a chance that benefits could be reduced up to about 20% if it's not fixed. But that's the number, 20%, not 100%. I'm pretty confident in saying that something will happen with Social Security so that nothing is going to happen like that. Okay. And talk is that we could raise the retirement age. We could raise the age to claim Medicare, raise payroll tax for high income earners. There's a lot of things that'll be done, but something does have to be done. And hopefully we'll come to some kind of agreement that everybody hates, which is always a sign of a good compromise, right? Quick housekeeping note. Next big numbers. Okay. Today the ADP, private payrolls came out and the numbers were 242,000 private jobs created in the last month versus expectations of 205,000. So another upside surprise in the labor market. I'm talking about this because anything to do with labor is going to get all the news now because that's the key metric that the Fed uses to determine its interest rate policy going forward. Friday, the big one, the non-farm payroll figures come out. Last month, there was 517,000 new jobs created. On Friday, the expectation was 225,000 new jobs created. Now it's like 250,000 new jobs created. In those numbers will be average hourly wages, average number of hours worked per week. There's a bunch of goodies in that number coming out Friday. So in 2 days, 8:30 a.m., that number comes out. The next big one is Tuesday next week. Okay, so in 6 days, we get the CPI figures for February. And we want to track that's the consumer price index. That's the inflation gauge we follow the most. We want to see how that's looking because it was going down from the end of 22 into early 23, but now it's peaking up a little bit. Not flying high. We've got to see how that does. And I misspoke. I said on the 16th or 17th next week that we've got I think I misspoke that the next Fed meeting is coming up. The next Fed meeting is the 20th and 21st of March. So the 21st, in 2 weeks, is a big meeting. Yeah. So anyway, 2 weeks from today is when the Fed comes out with their interest rate policy. Are they going to raise a 1/4 of a point or 0.5%, right? And then we'll see what their commentary is afterward. The betting is now that 70% chance of a 0.5 point rate hike, 30% chance of a 1/4 point rate hike. I would go with the betting because that gives the Fed leeway to actually raise a 0.5 point because it's pretty much factored into the market. Also tomorrow, I'm having a guest, Stu Almer. He is the executive director of the only one of its kind. It's a senior living center on Long Island. It's called a life plan community. And, you know, a lot of you are thinking, what's going to happen when you retire? What are you going to do with your parents, you know, as they age? So I'm having him here. This is a new concept for Long Island. It's not assisted living. It's not nursing home. It's not reverse mortgage. It's a life plan community. It's brand new. I watched the buildings go up every time I drove by them. So I'm having an executive director come on air and talk to us about this. It's a huge topic. What do we do in our later years, especially as our parents and us are living longer, and it costs a fortune to support ourselves in our old age. You're listening to 103.9 FM. 103.9 FM LA News Radio, Money in the Morning with Mitch Goldberg. Please tune in tomorrow so you can join my guest and I, Stu Ulmer. Thank you so much for joining us today, and stay tuned for more homegrown talent, more homegrown programming. Speak to you tomorrow. Thanks.
Securities and investment advisory services are offered through Next Financial Group Incorporated, member FINRA SIPC. Client First Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and Client First Strategy and not those of Next Financial Group Incorporated. Views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial Group Incorporated does not provide tax advice.